There are a number of structural growth themes in Asia. One of our favorite ones is around increasing consumption and premiumization. These come in different flavors across countries. For example, in India and Southeast Asia, it's about increasing penetration of a lot of basic products. For example, India sells about 5 to 6 million air conditioners a year, and it is a very hot country. Compare this with 80 million that's sold in China every year. So the room for the number of ACs to grow is quite large. In China, it's slightly different, where the basic penetration is high, but there's a clear theme of premiumization. Even in basic places like dairy, people are consuming more fresh milk, higher value milk. Same thing in beer, same thing in appliances. So these are quite strong tailwinds for companies and to grow their earnings over the years. Another area of structural growth in Asia is the healthcare sector. Um, Healthcare spending per capita is likely to continue to increase because of higher income levels, greater awareness about health, and an aging population, especially in China. Even with these tailwinds, it's often difficult to find good quality companies to invest, which is what we care as bottom up investors. For example, biotechnology. There's been a lot of capital that's gone into this sector. Many of the companies are zero revenue or they make massive losses. So, our ability to know about sustainable earnings of these companies in the next 3, 5 years is quite difficult. So, we tend to stay away from investing in these companies. Another area of pressure is regulatory, especially in China. There's a lot of pricing pressure on drugs as well as medical devices, which kind of puts into question the kind of profits the companies are going to make 3 to 5 years out. Another trend, long-term trend but we are less enthused about is around electric vehicles. China already accounts for more than 60% of electric vehicles sold in the world. Penetration has doubled sharply in the last year. But in terms of companies with strong economic moats and ones that can generate high return on capital, it is yet to be seen. There are a large number of competitors in this market. Many of them are trying to grow volume, and earnings is yet to be sort of clear that which ones will grow sustainably and which ones won't. Many of these companies have done well, but given the lack of conviction around the sustainability of the businesses, we generally tend to stay away, which means we miss out on some of the performance in the near term. But that's fine in terms of conserving our clients' capital. The China market in the last sort of 18 months has been quite volatile. I mean, there's been a number of headwinds as we have seen. Interestingly, we are bottom-up investors, so our process and philosophy focuses heavily on buying good quality companies. And when I say good quality, it's good managers who can look through different difficult environments, as well as franchises that can survive difficult economic conditions. So in the current environment, what we own on behalf of our clients in China are basically market leading franchises. So this could be the best beer company in China. This could be the one of the leading dairy companies or paint companies or the leading appliances air conditioner maker in China. These companies we expect to actually come out stronger in a difficult economic environment because their smaller competitors will not have the ability to withstand significant price increases on the raw material side. So we expect these franchises to actually gain market share and come out stronger with better returns and earnings. Obviously, the economic environment overall is difficult, so there will be some challenges, but our portfolio positioning is much more around finding these steady, good businesses that do better through more difficult period of time. That's what kind of most of the portfolio is focused on. China, like rest of the world, is actually facing a number of challenges. These are around increasing inequality, asset prices, slowing growth. The specific sort of issues that we are facing in China are around rebalancing the economy, which has been much more led by property and infrastructure towards a more consumption-driven economy. This means we have seen sort of regulations around property sector because it's just too large a part of the economy and the rebalancing has to happen. The second one is around regulation. We have seen this in the form of regulation around tech companies, common prosperity, where sort of some of the larger tech companies have been donating money. Again, you can call it as part of rebalancing sort of inequality or rebalancing the economy. These are risks to be aware of. In general, I think private companies are going to be in an environment of slower growth and more pressure on earnings, and that's something sort of as investors we need to adjust to. So, as bottom investors, we obsess about balance sheet. So, most companies that we own on behalf of our clients have strong net cash balance sheets. So, I would say in an rising interest rate environment, they are somewhat better protected than heavily leveraged companies. Their ability to pay dividends is also better. I think the challenge for nearly a large number of companies is going to be how to manage their overall earnings in an inflationary environment. Interestingly, most companies that we speak to in our meetings these days talk about inflation, that it's one of the toughest environments that they've seen from a cost perspective. To that extent, a slowing growth environment, slightly higher cost inflation than we have seen historically is just going to mean lower earnings. But for the companies that we own in the portfolio, which have net cash balance sheet, they should continue to pay out dividends in our view. So on the balance sheet side, on dividend payout side, we're actually quite comfortable with the companies that we are shareholders in. We are in really interesting times in the sense this time round, when you think of inflation, the developed world is probably facing a lot higher inflation than in Asia. It's surprising, it's different, but if you look up the Financial Times, the headlines in the UK or somewhere else, inflation, labor crunch, rising wages seems to be a much larger problem. So I'm not sure that the developed world is actually going to be better off in terms of dividend payout than in Asia, especially this time round. Also, I think in the past 10 years of very low interest rates in the West, companies have levered their balance sheet to buy back a lot of shares. Balance sheets in Asia for a number of companies, the good quality companies, are in better shape. They are in net cash. At the end of the day, it's going to be very much dependent on company by company, which companies are in better shape. But I would say this time around, I would say just the Asian companies probably, given the inflation scenario here and the balance sheet, are in a good position, a better, if not at least the same position like West in terms of paying out dividends. So we actually feel quite comfortable with sort of the shares and the companies that we own in Asia.